No doubt, Magnificent Seven certainly stole the show in many ways. It was one of the biggest storylines of 2023. So that group making up such a big portion of the gains that we saw for the market overall. Our next guest, Dave Sekera, is with us, Chief U.S. Market Strategist, Morningstar. Dave, thank you for being with us. We used to say FANG, FANG, then it became Magnificent Seven, and a lot of this group, as we came into the new year of 2023, was somewhat undervalued, and these names took off. What do you think drove that, and what does that mean for 2024?
Well, as you mentioned, the Magnificent Seven were certainly the story of 2023. But thinking about 2024, we're looking for the market really to broaden out across, multiple different areas, looking for where we see gains next year. As you mentioned, coming into this year, 6 of those 7 Magnificent Seven stocks, according to our valuations, were pretty significantly undervalued. They were trading at 4- and 5-star levels. But following the rally this year, 5 of those stocks are now fairly valued, trading with 3 stars. Alphabet, the parent of Google, is the only undervalued one that we still rate as a 4-star rated stock. And Apple has actually risen too far in our view. It's actually now rated 2 stars. So what I'm looking for next year is that broadening into other areas, specifically looking at value stocks. That's the one area that with market we still think is the most undervalued, trading at about a 12% discount. Core stocks are actually getting a little bit ahead of themselves. They're trading at a 4% premium. And growth stocks are pretty much in line with our fair values. Although I would note we do think tech stocks are overvalued, and I'd probably look to start taking some profit in tech and moving that into some of these other areas.
Well, we did actually see market breadth improving as the year went on. Throughout December, it was no longer just the AI stocks or big tech, right?
Exactly. And I think that's just going to be the story for next year. So I think here in the near term, the risk to the market, I think, is still inflation. We have PCE coming out later this week. I expect that that'll still continue to keep moderating on a month-over-month and year-over-year basis. But anything that could call that into question, I think, would probably push the markets down. But really, I think the next big test for the market's going to be in February and March next year. That's when management teams are going to report fourth quarter earnings. I'm not worried about fourth quarter earnings. I'm much more worried about the guidance and the body language they're going to give, for next year. We do think the economy is going to slow, starting here in the fourth quarter and then slow sequentially, all the way until the third quarter of next year. So I could see a lot of management teams, giving relatively conservative guidance, maybe trying to lower the bar, which of course at that point in time could, reduce, market sentiment. We could see a little bit of a pullback at that point. But overall, we think the market at current levels are pretty fairly valued.
Yeah. When you look at names like Meta and Nvidia, and you think about PE ratios, obviously we think about the S&P and we say 16 or 17. But then as you look at some of the high-flying tech, it could be 20, 30, 50, 60 plus for PE ratios. And a name like Nvidia, which tripled, I mean, it was over 200% gains. I mean, when I was checking, it was 240%. I mean, we can't gauge exactly where it ends the year, but the point is, had a huge move. But is there still more upside? Because there are folks who say quality, market share, it's okay if it's expensive. What do you say to those folks? Do you agree?
Well, again, we don't really focus on PE ratios. I know a lot of people look at that as a short-term way of, trying to gauge market valuation or gauge, individual stocks. We do a full discounted cash flow analysis. So when you think of something like, Nvidia, a PE ratio is really hard to gauge what that means, for the stock. Part of our model, we do look for revenue to grow, over 100% this year and almost 50% next. We're looking for a 5-year compound annual growth rate, on the top line of 35%. So essentially, we're looking for Nvidia's revenue to go from $27 billion in fiscal 23 all the way up to $121 billion by 2028. So I think you really need to think about the valuation of the company in that context as opposed to trying to look at a PE ratio.
Right.
Plus, when you look at Nvidia, those margins are going to more than double over that same time period. That's how we come up with our $480 share fair value.
Right, right. When we look at the names, you had Alphabet, Google, which you mentioned, 4 stars. A majority of the names that we've discussed here, such as Amazon and Microsoft, Tesla, Meta, Nvidia, those were all 3 stars. 2 stars, Apple. What do you tell Apple folks? Well, I mean, they love Apple. They may be scratching their head when you say that. And they say, oh no, what's he saying? Why doesn't he have more stars for Apple?
Well, and again, it doesn't come down to what we think of the company. We do rate Apple with a wide economic moat, so it does mean we do think the company certainly has long-term durable competitive advantages. It's just that we think the market has gotten ahead of itself when you look at the long-term fundamentals of the company. So I know, talking to our analysts, we just think that when we look at the long-term growth trends for like the iPhone, for example, the market, we think, is overestimating that too far into the future. We also think that the market is probably overestimating the long-term operating margins for Apple.
Right, understood. Dave Sekera of Morningstar, thank you so much for being with us. A look back on 23, look ahead to 24. Glad you were with us. Thank you.